Hello and welcome to Mortgage Watch. This is the Friday, March 14th edition, and here's your industry and financial news that affects your real estate and mortgages. Well, I wrote this late last night, and this morning I was captivated by news on CNBC. Volatility, volatility, and more volatility was the topic of my industry and financial update. Financial markets are being whipsawed around with staggering swings on any given day, both for the bond market and for stocks. This morning's news, for those of you who haven't had a chance to catch up, is that Bear Stearns has announced that they are in serious trouble, and basically the Federal Reserve stepped in and got J.P. Morgan Chase to guarantee all of Bear Stearns' capital needs, and the government is guaranteeing to J.P. Morgan Chase that they won't have any losses out of this thing. So basically the federal government is stepping in to prop up Bear Stearns, which has announced that it doesn't have any liquidity. As we talked about in recent weeks and months, the liquidity and the need for dollars and capital is just so important to everyone in the financial marketplace. And it's become harder and harder, and companies without capital are just staggered and just walking around looking for some assistance. Bear Stearns probably would have had a hard time functioning if not for the change of events this morning. The first news this morning was that the bond market was up 81 basis points. That's since corrected itself a bit, unfortunately, for mortgage rates. The stock market was hammered, and it's since recovered also. At 8:15 Pacific Coast time, President Bush spoke to the Economic Club of New York and basically defended what the administration is doing for an economic stimulus package, and that help is on its way, that it does take time, and so on and so forth. He didn't use the R word, but everybody else has been using the R word so far this week. Earlier this week, the federal government infused about $200 billion through its dealer network into the financial markets. The dealer network is a close group of about 20 or 23 Wall Street firms, mainly banks, that actually are allowed to do direct business with the Federal Reserve. They're the ones who can borrow money from the Federal Reserve. So when the Fed lowers rates, what they're really doing is lowering the discount rate or the federal funds rate that they charge banks and their dealers to put money in play. The more money that's around, the more money that's available, supposedly, for banks to lend. The government, in this latest action, exchanged Treasury bills for mortgages. So the federal government is now holding mortgages through the Federal Reserve. Will it help to solve the problems? Well, half of the experts say yes and half say no. But it shows that the government is taking this very, very seriously, and they're doing everything they can to try and move the markets along. Some of you have heard also that some other institutions besides Bear Stearns were in trouble. They're not as major as Bear Stearns, but their impact of them potentially closing is also and would be very, very dramatic, and I'll address that later. We will probably see a Federal Reserve rate cut on Tuesday. Whether it'll be 50 basis points, more or less, no one really knows, but there'll be a federal rate cut for sure to move this thing along. So aside from President Bush not using the R word, it is official. There is a recession. Well, duh. Everyone seems to know that except the people in the government. People that I speak to in service industries and trade, people recognize that it's really starting to have an effect. I just spoke to a client this morning whose son-in-law just got laid off, and he was doing speaker installations, home theater installations. So you know that it's starting to affect a lot of businesses, that people are not spending as much money because they don't have as much money. Obviously, foreclosures are hurting and everything else. The president insists that the plan they have is going to have positive effect over time. So that's good news. The other good news is that we've been in a recession for a while. I know people don't want to use that word, but most economists now feel that we have been for a while, and that's good news because the sooner we got into one, the sooner we can get out of one. So it's not bad news, it's good news that we're finally acknowledging it, and then we can deal with the problem. The better news is that there are buyers coming out to buy a lot of real estate that's on the market. There are hot deals on the market in most major areas. And so there are a lot of qualified buyers who actually didn't buy in the last 2, 3, or 4 years. And they are starting to step up. These are people who have good credit, who have jobs, who have income, and they're actually coming out of, I don't want to say the woodwork, but they're coming out in their communities and starting to buy, and that is a very, very positive sign. So as with most things, supply and demand and pricing is critical. With prices having dropped, there are people coming out to buy. The other news is that there has not been a bursting of the bubble in the housing market. Certain areas have been hard hit in the Midwest, but most areas of the country have seen 8 to maybe 15% reduction, and with the huge run-up that we had for 4 or 5 years, that's hardly the bursting of a bubble. It is a correction. It's not a bad thing. As I said, it's getting people out into the marketplace who were watching because they didn't want to buy when housing prices were climbing for so long. So that's good news. The other news that I mentioned last week is that predictions are still there for a bottom of interest rates at about 5.5% for the 30-year fixed. When it will come is anybody's guess. Probably in the next 3 to 6 months. Right now, here today, interest rates do not reflect what's going on in the economy or in the treasury prices, which is a real big disconnect. It's the greatest that it's ever been, but that's the nature of what's going on right now. Most everyone would think that rates would be a lot lower right now, but they're not. So we could see a solid 0.5% drop of rates being offered to consumers, and that would be very, very good news for mortgages, real estate, and consumers at large. The other point is that the 5.5% bottom may not last very long, so we urge everyone to be aware of it, to take steps forward, and be ready to capture the bottom when it comes. Because the other news is that once we get out of a recession and move forward, rates will probably go up fairly dramatically after that. In further industry news, margin calls are scaring everybody. Hedge funds, mortgage bankers, and even banks. Margin calls, as you know, is when people need to come up with money to cover, their positions, their paper, their security, their mortgages. When I mention hedge funds and mortgage bankers, that would include Bear Stearns. Bear Stearns' troubles are that they don't have liquidity. That's like capital. That basically means money, cash dollars to operate their business. Even though they are an investment banker, that's different than being a plain old bank that has depositors' money. They still rely on borrowing and liquidity to make their performance. There's also talk about National City Bank, which was a major play in the mortgage market, having a lot of trouble because they did a lot of subprime lending. They owned several subprime lenders, including First Franklin, for a while, and so there's talk about them having some issues also. In other exciting news, the FBI is investigating Countrywide Mortgage for securities and mortgage fraud, and that will be very, very interesting. The cases center around stated income loans that supposedly were approved by Countrywide underwriters under orders to approve the loans, even though they didn't like those loans. This is the result of a case in which someone pled guilty to mortgage fraud and is now basically rolling over and saying, well, it was a company policy, and let me tell you how it all happened inside. This will be a very, very interesting story in weeks and months to come. Carlyle Capital was basically announcing that they're either liquidating themselves or very close. That is bizarre because they are owned 15% by Carlyle Group, which is a major behind-the-scenes hedge fund. It has a lot of major players, former administration officials, like former President Bush is a major player in Carlyle Group. Several Saudi Arabian princes own big interests, and other former government officials are involved in it. The fact that they have a hedge fund, Carlyle Capital, that is in trouble due to their holdings is very, very ominous and interesting. So we'll just see where that plays out. In other news, Chase announced that they have increasing home equity losses. Even though they were barely touched by the subprime problems, their home equity losses have kind of doubled in the last 3 to 6 months. They're joining National City, Washington Mutual, and other players that are seeing that. Well, of course, the home equity loans that are having trouble are those that are written to 100% LTV, stated income 100%. So again, those are problem areas. I do not believe they're having problems at 80% LTV. Those people have equity, those people have assets, those people still have good credit. In other news, some of the major players that froze lines of credit have started to unfreeze them in certain situations as they realize that there are still a lot of good borrowers out there. They just need to do a better job of separating out good borrowers from bad. And that's kind of what we're going to hear later today when Nancy speaks to us about FHA, because they are really going to help this market through that. So with that, I wish you a good week. Thank you for tuning in to Mortgage Watch, and we'll look forward to having a fresh presentation for you next Friday.